Uh, how does that work into what we're seeing with Silicon Valley Bank?
Yeah, so I think the simplest is if we sort of sketch out what an economy would look like that was completely free market, right? So what would free market banking look like? And I think what it would look like is that you would have two categories of money that you're putting in the bank. You'd have one category, which is a demand deposit. That's what most people think of their bank account. A demand deposit, you can take that out at any time, right? You can walk right to the ATM and you can take your money out of the bank. It is, from the bank's perspective, it is a debt to you, okay? And you can call that debt at any time, all right? And then you've got another category of savings, which are time savings. So most people know this as a CD, a certificate of deposit. And in the case of a CD, you're essentially lending the money to the bank for, let's say, 1 month or 3 months or 1 year or whatever. You typically get a better interest rate on CDs, all right, because your money is locked up. And so in a free banking system, right, today, by the way, about 20% of money is in checking accounts. In other words, that's money that people expect to, want to use in the near future. About 80% of money is in savings account. And so we can infer that in a free market system, what would happen is roughly 20% of the money would be in that demand deposit pool. And there, the customer is basically warehousing their money in the bank. They're storing their money in the bank, but they expect that money to be there for them whenever they want it. And then the other 80% of money is effectively lent to the bank. And there, if you've got a 3-month CD and you need the money tomorrow, then you got to find another way, right? Because the bank doesn't owe you, even though, yes, it's your money, but you lent it to the bank for 3 months. So, you got to go use the credit card or whatever. So in a free market banking system that worked like that, you would have full reserve. So the deposits, the demand deposits would be fully backed by cash, right? If you, the bank, are telling the customer that their money is there, the money better darn be there. All right, so the demand deposits would be fully backed with cash, not with bonds, not with gold. We'll get into that later in the thing, because those things fluctuate. All right, cash. If the bank account is listed in cash, then the backing asset should also be cash. So that'd be about 20%, meaning about 4.5 trillion. And then the other 80%, the part that's in the CDs, the part that is paying a better interest rate and that is on a term, right? So in other words, it's a time deposit. Those would continue to be lent out. All right. So in a free banking system or in a free market banking system, without FDICs, without the Fed intervening, that's the kind of economy you would have, right? You would go to the bank, you put some of your money in long-term savings, they would lend that out, and the part of your money that you keep in a demand deposit, the cash would be there. That is a perfectly stable system. If the bank screws up and nobody has faith in them, well, the CD holders can't do anything about it because they lent the money on term. The demand depositors may come in and take their cash, in which case the bank will get smaller, but it's not going to go bankrupt, right? In other words, they have $1 billion in demand deposits. They have $1 billion in cash. If all the people come to take the $1 billion out, then the bank is not in good shape. They are smaller than they were yesterday, but they are not bankrupt. There are no bank runs in that system because it's fully stable. Everything that can immediately be taken out is backed. So that's the ideal. Now, what do we have today? And what we have today is that the banks pretend that all of your money is demand deposit. Almost all money is either checking and savings. In our current system, checking and savings are both demand deposit. You can go and take all your money out. But the banks, they don't have the money. Right. So you, the customer, are under the impression that your money is sitting there like it's in a warehouse, but actually the money is not there. And so they move heaven and earth to try to deceive and gaslight. And literally many jurisdictions they've made it a crime to cause a bank run. In other words, if you tell people that the bank is technically bankrupt, which it is because it owes you money immediately and it doesn't have that cash immediately, that is the definition of bankruptcy. But if you communicate to that to people in many jurisdictions, we here are talking about in the abstract. If you communicated about one specific bank That is literally a crime in many jurisdictions, which is insane. But the reason is because the banks, the Treasury, Fed, the entire edifice does not want you to know that the money is not there. So why do they do that? Why do they, double count money and pretend that it's there when it's not? Because they can do something called fractionally reserve. All right, the individual bank, it takes in your $1,000. In theory, it puts, say, $100 in the vault, and then the other $900 it lends out. And when you zoom out and you have that process with every bank, right? So whoever you give that 900 to, the guy who fixes your fence, he then goes to his bank, and his bank puts, 90 away, and it lends out the other 810. The next guy puts 81 away, lends the rest, etc. By the time you're done with that, you get about 10 times or 20 times the money created. So effectively, the banks become licensed counterfeiters. And the cost of it is that the only way that the thing can work is if the banks are always operating in technical bankruptcy.
Yeah. So, and basically, I think Mises in Money and Credit does claim that this is essentially legalized fraud. That two people have claim to the same exact money. So, legally, it is an impossibility. Legally and economically, it is an impossibility, because if both people were to go to the bank and ask for their money, the bank would not be able to do anything.
Right.
But today, it appears that the Federal Reserve is trying to be like a backstop to this process, and they are willing to now pay back all depositors